Hi, I'm algo trader Martin, and today I'm going to give you some insights into a trendy approach called Golden Cross. The basis of the Golden Cross is the MLM Index, a trend tracking formula developed by Mount Lucas Management, a quantitative investment management firm. The formula is designed to track stock market performance and help identify trends. The MLM Index uses a simple algorithm that takes the average price of the S&P 500 index over the past 200 days and compares it to the current price of the index. If the current price is above the 200-day moving average, the formula generates a buy signal indicating that the market is in an uptrend. Conversely, if the current price is below the 200-day moving average, the formula generates a sell signal, indicating that the market is in a downtrend. The MLM Index is a simple and easy-to-use tool for traders and investors who want to track market trends. However, like any trend-following strategy, it is not foolproof and can generate false signals in volatile or choppy markets. The MLM Index is also based on the Golden Cross strategy, which is a popular trend-following strategy used by traders and investors to identify potential buy signals in the stock market. It is based on the intersection of two moving averages, the 50-day and 200-day moving averages, and is considered a bullish signal when the shorter moving average crosses the longer-term moving average. The term Golden Cross refers to the intersection of two moving averages that forms a cross-like pattern on a chart. The 50-day moving average is a short-term trend indicator that measures the average price of a stock over the past 50 days, while the 200-day moving average is a long-term trend indicator that measures the average price of a stock over the past 200 days. On this slide, I have marked one input and output according to the strategy rules. For example, when the 50-day moving average surpasses the 200-day moving average, it is considered a bullish signal indicating that the stock is likely to continue its uptrend. The strategy of crossing two or even more moving averages is nothing new to algo trader. In StrategyCont X, I have set the necessary parameters in the template, and here you can see the backtest results for 4 stock indices and 5 major Forex markets. The results are sorted by the net profit column. Each market was set to the maximum history of available data, but that was not the same for all markets. Initial capital $100, position size 1/100th of a lot. Equity indices traded only on the long side, Forex pairs also on the short side. As one might expect, this approach works on stock indices, which is not surprising, and lags heavily on Forex. If we make a portfolio out of all the markets, we get an average annual gain of almost 25%, but with an open drawdown of $1,700. A portfolio of stock indices would indeed increase the average annual gain to 100% with a lower open drawdown. But if we ignore the size of the capital required, there is an but. And that is the extreme numbers of days of open positions. Looking at the last column, sorted in descending order of time in trade, it is immediately clear that the swap costs would be disproportionately high when trading these markets in MetaTrader 4 or 5. So in effect, trading this approach in the futures markets would come at a cost, which in turn is capital intensive.